I started buying RaySash under $100 million market cap. Currently, it has reached over $850 million. In this video, I want to briefly talk about the 3 mistakes I have realized that is keeping investors from having multi-baggers like this one. First mistake is being afraid of micro and small cap stocks, avoiding smaller companies. Early on in my investments, I always wanted to find companies that I and many other people use or knowing them for a long time in order to limit my downside potential, as I assumed that these companies are basically indestructible. And if I diversified in them, even an outlier actually failing couldn't take me down, as the rest of them would keep on winning. Let me just say that while I don't invest like that anymore, it is not the worst assumption. The problem with that approach is that if you are lucky, you will outperform the overall index by a couple points for a long time while spending hundreds of hours reading the reports of all the companies you have. When I look back, I think that investing in an index rather than using this method makes so much more sense, as the results will be basically similar. I believe it is really hard to find no-brainer deals in the companies with hundreds of billions of dollars in market caps. Every once in a while, you will get deals like Meta, which I actually took advantage of, Netflix and others. But to find them on a regular basis that you can keep buying for a long time is an incredibly hard job that hedge fund managers who can do it on a regular basis earn millions of dollars in compensation. Instead, looking at the places with much less eyes on, in my opinion, is the key to finding deals in the stock market. I love quoting from Charlie Munger, and my favorite quote of him is, "I have a friend who says the first rule of fishing is to fish where the fish are. The second rule of fishing is to never forget the first rule. We have gotten good at fishing where the fish are." RaySash, the company I keep talking about, is in Turkey, and until Monish Pabrai started to invest in them, nobody even realized the potential there, including me. The second mistake is to being stuck to your original cost. I recently bought more RaySash. I'm still buying it, which means I'm paying around 10 times my original cost. Now, that may come as a real shocker to you, since the initial buys I had with RaySash began in late 2021, early 2022. Back then, it was only a small position for me, around 10%, and I had mostly Meta, Amazon, and Google, as I thought that big tech was just so cheap and an easy bet that I couldn't see myself losing significantly if I bought them. Unfortunately, it took me a while to realize that mostly RaySash, but to a degree Tav as well, had the potential to be multi-baggers in such a shorter amount of time compared to the big tech I was buying and holding, as their market caps were in trillions of dollars. They needed to add trillions more just to be a double, other than Meta. I sold out of most of my positions and bought RaySash and Tav, most RaySash. And I kept buying more each month as I had new capital to invest, and that decision has paid me nicely. I talked about Charlie Munger's bad rejoice story before in the channel, and it has been one of the great lessons I have learned in my lifetime. When you find an opportunity like that, not taking advantage of it to the fullest is one of the greatest mistakes that investors make, in my opinion. Another thing that I realized is that you can get too attached to your initial buys, and later on it becomes too hard for you to increase your position at multiples of your original cost. As I said, my initial cost with RaySash was under $100 million. If I stopped when it got to $200 million, which is a double of my original cost, I would have lost on the 4x that I got by keep buying at $200 million valuation. As I said, I just kept buying, and at $400 million valuation, it was 4 times more than my original cost, and I still got a double from that one too. So instead of focusing on what you paid in the past, in my opinion, you would do much better to look at the intrinsic value of the company, compare it to the market cap, and keep buying if you find the difference to be attractive for you. I'm not saying just keep on buying great compounders at any price. There is not even a single company that is worth buying at any price, in my opinion. I see this a lot in the stock market. When a company just keeps going up, especially the new investors believe it can keep going up forever and buy these companies regardless of their intrinsic value. So the second mistake is being stuck to your original lower cost and missing out on the potential of the future. When you find a company that you believe should be trading at $2 billion and it trades at $100 million, you shouldn't stop buying it at $200, $400, or even $800 million if you actually believe it is worth $2 billion. Unless, of course, if you have better options in the market that you can put your capital to work. Smart people always think in terms of opportunity cost. One final note about this second mistake is I currently have over 70% of my portfolio in RaySash stocks. That is thanks to my conviction. I have spent countless hours studying the business, and that allows me to carry the company at such a high conviction and not selling it. Third mistake, I believe, is the worst among them, and that is selling your compounders after you had huge gains. Warren Buffett frequently emphasizes the importance of a long-term perspective, and for good reason. His approach to investing is grounded in the belief that the best opportunities come from holding quality companies over extended periods. This patience allows the power of compounding to work its magic. Buffett once said, "The stock market is designed to transfer money from the active to the patient." This quote highlights that the key to substantial returns often lies in staying the course, even when the market seems volatile. Similarly, Charlie Munger's advice is basically buy good companies and sit on your ass. So just because you have doubled, quadrupled, or however many times you have made your initial investments, it is never a good idea to sell your compounders unless they are outrageously overpriced. So, to summarize, the first mistake is being afraid of the smaller companies, where you are much more likely to find multi-baggers. The second mistake is being stuck to your original cost and not loading up enough, being too diversified. Finally, the third mistake is selling too early. If you are curious about the companies I talked about here, like Resash and TAV Airports, you can try to subscribe to my Patreon, where I release deep dive analysis for both companies, and there you can find many other content regarding these companies. I will also be releasing a deep dive on one of the biggest bottlers in the Coca-Cola environment, Coca-Cola içecek, this month as well. You can also subscribe to my YouTube channel. Any comment is appreciated, and I'll see you in the next one.